Let me just share a thought. The other day, my family and I, we were reading in Helaman, 5:29-30, and Nephi and Lehi were teaching. And they were teaching a hardened people. And you guys, you remember this. They were taken, they were cast into prison. They were not given food. They were about to be killed. And as you remember the story, the Lord sent a miracle. And what the miracle was is they were encircled by fire. The Lamanites could not kill them. And this cloud of darkness came over. And as they were speaking, there was a voice. Came as it were above the cloud of darkness, and it said this. And it says, and it came to pass that there came a voice as if it were above the cloud of darkness, saying, repent ye, and seek no more to destroy my servants, whom I have sent unto you to declare good tidings. And it came to pass when they heard this voice, they beheld that it was not a voice of thunder, neither was it a voice of great tumultuous noise, but behold, it was a still voice of perfect mildness, as if it had been a whisper, and it did pierce them even to the very soul. And notwithstanding the mildness of the voice, behold, the earth shook exceedingly, and the walls of the prison trembled again, as if it were about to tumble to earth. And behold, the cloud of darkness, which had overshadowed them, did not disperse. And the voice came again, saying, repent ye, for the kingdom of heaven is at hand. And seek no more to destroy my servants. And it came to pass that the earth shook again, and the walls trembled. And also the third time the voice came and did speak unto them marvelous words, which cannot be uttered by man. And the walls did tremble again, and the earth shook as if it were about to divide asunder. You know, as I read this, I took away three important lessons. Number one was the mildness of the voice. It wasn't harsh. It wasn't tumultuous. It was a perfect mildness, almost a whisper. Number two, it's not only what was said, but it was the fact that it pierced them to the very soul. And number three, the message came 3 times. Why 3 times when one was sufficient? And so from this scripture, I took away 3 important lessons. Lesson number 1, am I living in such a way that I can hear the quiet promptings of the Spirit? Do I have sufficient time away from the hustle and bustle of life that I can listen and I can hear his quiet promptings? Number 2, am I doing those things that would bring me closer to and more worthy of the companionship of the Spirit, so it can pierce me to the very soul? Or are my actions consistent with the things that I'm trying, with a person who's trying to be a companion to the Holy Ghost? And third, am I ready and willing to do the things that the Spirit says without having to be told 3 times? It's not enough to hear the voice of the Spirit. We must be willing to act. As we read the scriptures each day, part of our learning, even by study and by faith, hopefully we'll take the things that we read and try to apply them in our lives. Okay, investing. Today is our last day. I apologize. I thought I sent an email to everybody in the class and said, okay, what final questions do you have? And we'll address those today, but apparently I only sent it to the other session. So as we're thinking through here today, we will continue. And as you have questions toward the end, we'll hopefully be able to answer that. So today is our last day on the investing side. And so our goal is when you leave today, you'll know how do you go on? How do you open an account? How do you do all of those things here? So here's section 9, investments 9 on portfolio rebalancing reporting. Determine the type of rebalancing you will use, how often you will rebalance. Include this in your investment plan. So someone want to define rebalancing? Someone want to try? Go ahead.
How often you change what your portfolio actually is balanced at?
Right. Right. How often you change your risk level, your asset allocation. You sell out asset classes that hopefully have done well. You buy ones that have underperformed. So how often do you change that allocation? Think through the new money / donations addendum and how you will utilize it to minimize transaction costs. We'll talk about another way of balancing your portfolio that minimizes the tax implication. Determine how often you'll monitor and report on your portfolio. Determine how you'll communicate portfolio results. And then we have another one, which is behavioral finance. Behavioral finance, we'll spend a little bit of time today just to kind of go over some of those things here. And these are things, what can we learn about investor behavior to help us to be better investors? And that's it. Again, as we said before, one of the biggest detriments to portfolio performance is ourselves. And then the last part today is I'll just answer a number of questions that previous semesters have asked, and then hopefully we'll be able to answer any questions that you have today. So that's kind of our framework today. So let's start with a case. Steve and Susie, both 45, aggressive investors. They have $250,000 portfolio. They've invested in 10 mutual funds. Their actual weights are different from their targets due to outperformance of the equity part of the portfolio. Does that sound normal? I was just looking at our student-run fund. So we're in March and we're already up 11%. So if this was part of an equity, a stock and bond portfolio, the equities had outperformed. So asset class weights are different from their targets due to outperformance of the equity part. So when should they rebalance their portfolio and how should they do it? What happens if they don't rebalance their portfolio?
Then they'll be overweight equity and they'll be more risky than they want.
So they'll be overweight equities, then they'll be taking on a lot more risk than they want to do. And what happens when you've got a lot more risk in your portfolio than you want? If markets do poorly, then you can do a lot worse. So the question is, how do we rebalance? How often do we rebalance? And what's the best way to do it? So rebalancing is really just redoing the portfolio to a position more consistent where you want to be. And it can come from a lot of different things. Asset performance. You can all of a sudden you decide, well, maybe I want to add 3% into my portfolio, 3% of gold, let's say, but so you can add an additional asset class. Maybe it's new capital. Hey, wait a second, I just got my tax return back. I've got an extra $5,000 we want to put in. Maybe it's investor objectives or risk. Well, the last time I rebalanced was when I was 25, I'm 30 now. Now I probably want to just reduce my equities just a little bit. So lots of different reasons why we do it. Why is this so critical? No, there's just competing principles. One is transaction costs, and number two is to kind of minimize tracking error. So tracking error is just the difference between your actual return of your mutual fund and the return of your benchmark. And so why do we want to minimize this tracking error? Do we say that we'll accept the risk of this portfolio, which is 50% large cap stock as measured by the S&P and 30% bonds as measured by Barclays aggregate and 10% international is measured by Morgan Stanley, MSCI, and 10% small cap is measured by the Russell 2000. So if we're not tracking the benchmark that we want, it means we're at a different risk level than we would like. So there's lots of ways to rebalance. When I first started teaching, I had like 6 different ways. But 95% of the people just rebalance using these 2 ways. So I thought I would emphasize that. So let's just talk about the different ways. So periodic rebalancing, it just says, okay, we're going to rebalance on a specific period. Generally, what I recommend is basically annual. And so what you would do at a certain point in time, maybe December, you would rebalance. You'd find your asset classes that did better, and you'd either sell out of those or you would buy the asset classes that did worse. But once a year, you'd kind of sit down and you would rebalance back to your original target allocations. Now, the nice thing about this, it's the most simple. Longer periods have lower transaction costs. Disadvantages, it's independent of market performance. So here we are in March, and The large cap stocks are up almost 10%. What do you think bonds have done over this same period? Probably, 15 basis points, 20 basis points. So the downside is it's independent of market performance. And so performance now will just kind of depend on the relative timing of large market moves and things like that. So that's one way to do it. You can just do it every December. We rebalance the portfolio. Generally, for most students, when you're starting out, that's probably not a bad way to do. You could also do it what I call percent range-based rebalancing. Okay, you rebalance the portfolio every time any of your allocations get beyond, say, plus or minus 10%. You guys remember on your investment plan, beginning allocation, your target, minimum and maximums? So when we do that type of work, we're actually working here, plus or minus 5% or plus or minus 10%. So what you do is you just watch your allocations. I've got Quicken, and so I look at my portfolio, once a week when I do that, I look and say, okay, here's my allocations, here's my target, how far off am I? And so you can do it here. Nice thing about this is easy to implement. If you have wider ranges, say plus or minus 10%, you'll have a lot fewer transaction costs because it won't trigger very often. Disadvantage, how do you set that effective range? And then the other disadvantages is your largest asset classes will likely give you the largest. Those are the asset classes that will cause you to rebalance. Now, do we all understand what happens, why you need to rebalance? There was a number of people in the early 2000s when the markets had run up. I guess it would be late 1900s, 1990s. And there was a period of about 5 years where the equity markets were up 25% a year. And so people who started in that allocation started at 60-40, but by the end of that time period, that fifth year, they were like 80-20, 80% equities and 20% bonds. And then when the crash hit, it just really devastated them. And the point here is if we don't rebalance, we're taking on a lot more risk than we would like to. Now, the challenge here is how do you rebalance in the most tax-efficient ways? So, any thoughts? So you've got a portfolio at 60-40, and now you want to rebalance. Yes?
So I open up a Roth IRA,
Okay.
and every month it just automatically takes $200 out of my account, like invest in an index fund.
Okay.
What would you say in a situation like that?
Okay. So how do you handle it? He's got a Roth. Now, that's just, my guess is that's one part of your investment portfolio. But and how do you invest that Roth? Is it in equities or it is in bonds?
So it's in it's the Fidelity 4-in-1 index, about 50% in U.S. large cap stocks,
Okay.
20% international, 20% bonds, and very small 2% cash.
Okay, so this is in a fund that already has an asset allocation there. It's already diversified. So you probably wouldn't need to do that. Wouldn't need to reallocate that, assuming that's consistent with your target. But with you, each of you students here, you're going to be saving 20% of every dollar you make. And that's going to be going in. How do you handle that allocation? Let's say you start, your allocation is 80-20, 80% equities and 20% bonds. And by the end of the year, you found yourself, you're now at 85-15. How do you do that, and how do you rebalance?
I think like you were saying before, using equities that have gone up in value to pay your tithing.
Okay.
Those equities, so kind of using that in a tax-efficient way to...
So that's right. So anyone, Herb, I call this NMD/donations addendum. And let me go back to the first point. Well, the first thing you can do is, you're overweight equities. You have less on bonds. I don't like to sell anything. I like to buy a fund that I can hold for 40 years. And so, in my asset management class, we try to keep our turnover, and this is a student-run fund, at less than 20% a year. So what I'd like to do is, let's say I'm underweight bonds in my asset class, what I'll do is I'll stop contributing or slow down my contribution to the equities, and then I'll put any new money going into the bond asset class. So good, I don't have to sell. And I can I can just put new money into that asset class. The other thing that Reese was talking about is we pay ourselves monthly. How about a donation strategy? So what the donation strategy is we take the assets that have done well, and again, these are only in taxable accounts. Can you do this in a non-taxable account? No, because you haven't paid taxes on those. So what you do is you take the money that, we've got securities, let's say right now, our equities have outperformed, so we've got significant capital gains there. How about donating those securities to pay your tithes and offerings, and then taking the money you would have spent for your tithes and offerings and use it to buy your underweight asset class? So you've got an asset you paid $10 for, it's worth $20 now. If you sell it, what are you going to have to pay taxes on? How much? Capital gains of how much? $10. What's capital gains is right now? Yeah, we're still not sure. But somewhere between 15 and 20%. How about if I take those shares and I donate them to the church or to a charitable organization? But in our case, for tithing, we donate it to the church. What do I recognize that donation as? At my cost or at market value? Market value. Do I have to pay those capital gains? No. And then I take the money that I would have spent, I buy the underweight asset class. And so now I bought the bonds.
So the only time it makes sense to pay for or to make donations with your investments is if you're planning on selling them anyway.
Yeah, and if you've got a capital gain. Why wouldn't I donate a stock that I had a capital loss on? Yeah, because I could sell it and then I could write off the capital loss. But the important thing here is that we think through. We think through the rebalancing strategy, and we sit down once a year or so, or whatever you decide to do, and rebalance your portfolio. So what's the best one? What I found with most students is a combination of periodic-based and percent range-based rebalancing. And I really like that new money / donations addendum. And that's actually what my wife and I use. That's how we rebalance our portfolio when we can. Again, our goal is to minimize transaction costs, taxes, and tracking error. So questions on rebalancing? Okay. Question, is risk important? When we're talking about investments, is risk important? Yeah. Why? Why is risk important?
Well, that's how you earn money. If there was no risk at all, you wouldn't be able to do that.
Okay. So, if risk is important, how would you define outperformance then?
It's still risk.
Still risk, but what is outperformance? Variability? Positive variability against a benchmark? Would you say that? In the asset management class, we're judged against a benchmark of 80% S&P 500 index and 20% Russell 2000. So that's our benchmark. And our goal is to beat that benchmark. Is it important to take risk into account? Risk into account when we're talking about performance. So you've got two funds, both gave a 5% return. One was a bond fund, one was an emerging markets fund. Both gave you a 5% return. Are those returns equal? Probably not. Which one's higher risk? Yeah, the emerging markets. So do we need to do risk-adjusted returns? Yeah, you probably should. Now question, do you need to do risk-adjusted returns with an index fund? If it truly follows the index. If it truly is an index fund and it follows the index, do we need to worry about risk-adjusted returns, or should the returns be exactly the same as the index? It should be the same. Okay, let's say you choose not to go with an index fund, but you want to do another fund. How do you tell if a stock has outperformed? Let's do another case. You're reviewing the performance of one of your non-index funds. It's actively managed during the most recent sample period. Here, T-bill rate during the period was 4%. How do you tell, did this fund outperform on a risk-adjusted basis? You guys remember these things, the Sharpe, the Trainer, and Jensen's Alpha? How do we calculate those? So you guys remember these from your finance classes? Let's go through and we'll just do this. First of all, did this fund outperform? So, hate to say it, oh, sorry about that. Minor detail. Okay, here's the fund. Here's the market. So let's review some of our finance theory. Remember your Sharpe ratio is the return on the portfolio minus the risk-free rate divided by the standard deviation. So what's the Sharpe ratio for the fund? Yeah, 0.31. Good, 0.31. Did it outperform or underperform? Ben? Well, how do we know? Do we know? No, what do we have to do? We have to compare it to the benchmark. So what was the Sharpe ratio for the market? Bao said what? 0.25. So did it outperform? Yeah. So this is you've got your efficient frontier. Here's the slope here. The higher the number. So on a risk-adjusted basis, did fund XYZ outperform the benchmark? The answer is yes. How about Trainer? Now instead of using standard deviation, we use the beta of the portfolio. What was the portfolio there? So 12 minus 4 divided by 1.2, 10 minus 4 divided by 6. I'll just do the math. 6.7 and 6.0. Did it outperform? Yeah, it did. How about if we do Jensen's Alpha? So what's this right here? CAPM. So here's the actual return on the portfolio minus what was expected from CAPM. Do we have to do this for the market? No, because that is the market. So did they add value there? What do you think? I'll give you the calculation. So do they have a positive alpha or a negative alpha? Positive. So did they add value? Yeah, they did. So in this case, the fund did outperform using each of the three measures. All three measures, alpha, Trainer, and the Sharpe. So which measure is most appropriate? And generally what research found, if it represents the entire index for an individual, the Sharpe index compared to the Sharpe index for the market is best. If you've got many alternatives, it's only part of the overall portfolio, I'd probably use the Trainer or the Jensen's Alpha. And generally, most academicians would say that the Trainer measure is probably a little bit more complete. Okay, let's do another problem. But we'll do Yahoo Finance. Five mutual funds. Your fund 1, 2, 3, 4, 5. I want you to go up to Yahoo Finance. And I want you to see, did this fund outperform on a risk-adjusted basis? So I'm going to just take you through it here. And I'll just do so finance.yahoo.com. And I'm just going to pick one here. And I'll just do Vanguard S&P 500 fund. So what we're going to do is we're going to come down to risk. And we'll use the 3-year here. So here, notice here is your standard deviation. Here is your beta. Here's your Sharpe ratio. And here's your Trainer ratio. Now, what they do is they will use what's called the category average, the category. So they'll take all large cap stocks. Can we use that as a proxy right now for the benchmark? Probably okay. So let's look at VFINX. Notice the R squared against the standard index. Is this a pretty good, do I need to do risk-adjusted returns when it's 100%? So it basically says it tracks it perfectly. Notice the beta, 1.0. So let's see. So here's your Sharpe ratio, 0.93. That's the Sharpe ratio of the fund. And notice we have it over 5 years versus 0.77 over the last 3 years. Assuming that the category, we use that as a proxy for the market, has it outperformed? Yeah. How about using the Trainer ratio, 13.88 versus 11.24, has it outperformed? Yeah. Now let's look over the last 5 years, 3.5 versus 3.56, probably flat. 0.28 versus 0.28, about the same. How about 10 years? So has it outperformed 0.47, 0.46, 6.8, 6.0? The answer is yes. Okay, let's go through. Let's go back to the Have you picked those? Let's give you just a minute. So I picked a bond fund, a large cap fund, a small cap fund, emerging markets fund, and a REIT. And so our question is, have they outperformed on a risk-adjusted basis? So let's start. How about VIPSX? Did it outperform? Sharpe? What did you guys get? Go ahead, Thomas. 3 years it underperformed. How about what versus the Trainer? What did you guys get? Under. Okay. How about the Charles Schwab SWPPX? Outperformed both of them? Okay. How about FSCRX? So it outperformed? So 1.07 versus 1.76. So it outperformed on both of those. How about the Emerging Markets Fund? Chelsea, what did you guys get? No. Okay. Actually, oh, yeah. And then the last one was, how about the REIT? REIT had no debt. So basically we have the data, but they didn't have versus the category. But what I want you to see is we can actually go in and this is not rocket science. It's pretty easy to do. And this is just Yahoo Finance that we can go. Now, my final question is, again, if you have index funds, do we have to do this risk-adjusted return? No, because if it's a correct index fund, it'll actually be giving us those returns. Jared?
Is a Sharpe ratio correct on that for DNQ? It's 17.
Yeah, I would assume it seems a little weird. The number seems a little bit high. And there's no category stuff here. Maybe next time I'll pick a different one that they have both of that there. So our point here is we need to understand. You know, risk-adjusted returns are important. Again, if you do choose to use index funds and you don't have to, the nice thing about those is if there's no tracking error, it should give you the exact same return as the index, plus or minus a little bit of expense fees. So it's kind of a fun thing. Okay, let's move on to behavioral finance. So any thoughts? Someone want to define behavioral finance for me? What's behavioral finance? And why did it come about? Any thoughts?
I don't know whether it's right, but like the assumption in economics is that people are rational.
People
make rational decisions. Behavioral finance says that that's not necessarily true.
So people make rational decisions, okay? That's one of the assumptions. Now let's look. In 2008, the markets were going down, and January and February, and people were selling out. And so they've stayed out of the market until now in 2013 when the markets come back. They're going and backing and coming back into the market. Is that rational? So they sold out low and they're buying in what? High. Is that rational? Are we rational? You know, we're not. So people make rational decisions, are unbiased about their predictions for the future. Is this really the case? Let's do a couple of thoughts. Are there aspects of personal behavior that go contrary to this? And let me just give you some examples. What behavioral finance tries to do is tries to incorporate personal behavior into to extend finance beyond its assumptions. So let's give you an example about rational. Go to the grocery store, you need purchase paper towels. They're 10% below their normal price. What do? We buy more. We buy a case. Here's another thing too. You invest in the stock market. You own 100 shares of Boston Scientific. Stock comes in, the stock drops 20%. What do? You sell. But wait a second. If we were rational, instead of selling the stock, we would buy a case like we did with the paper towels. What's the difference? Let's look at another one. Which is larger, the top or the bottom? We know they're what? We know they're the same, but which one really looks larger? The top. And I know because I copied it exactly, and all I did was switch the ends. We know the answer, the stop line still looks larger. How about this one? So the interesting thing is we have those bias. Steve?
What did the last example have to do? Like, how does that relate to?
Okay, so the first one is we're rational. Supposedly we're rational investors. And yet in that third one, we see him and it still looks larger. If we were rational, we would know, but it still looks larger. The second assumption is we're unbiased predictors. How many people have done this case where we ask you 10 questions? Okay, so you guys just be quiet, okay? So the second question is we're unbiased in our predictions. So our brain doesn't work like a computer. Okay, hold on a second. So we're going to do one more activity. And what we want to do is I'm going to give you 10 questions. And what we want you to be is we want you to be 90% sure that your answer is correct. So you get that? You want you to be 90% sure. So you can guess as high as you want, you can guess as low as you want, or even a range, but you want to get a minimum 90% right. Okay, do we understand that? So grab a pencil, and we're going to ask you 10 questions, and I'd like you to write the answer. And again, I want you to be 90% right. Okay, so start with question number 1. What's the average weight of an adult blue whale in pounds? Write it down so you're at least 90% right. Matt's laughing back there. He's taken this before. Question number 2. What year was the Mona Lisa painted? Three. What was the number of independent countries in the world in the year 2000? Again, you want to be 90% right, sure. 4. What's the air distance in miles between Paris, France, and Sydney, Australia? Not Paris, Utah, or Paris, Idaho. Question 5. How many bones are in the human body? Again, you want to be 90% right. Okay, we ready here? Because I'm going to flip the screen. We ready? Question 6. How many total combatants were killed in World War I from all sides? Question 7. How many books were in the Library of Congress in 2000? Question 8. How long is the Amazon River in miles? Question 9. How fast does the Earth spin at the equator in miles per hour? And question 10. I know this is an old processor, but still, how many transistors are in the Pentium 3 computer processor? Okay, you got your answers? So again, we wanted you to be 90% right. So let's kind of go through the answers. Weight of the adult blue whale? Eric, what'd you put?
100,000 pounds.
Right, 250,000 pounds. Eric's got to get all the rest of them right. Year the Mona Lisa was painted. Dallin. What'd you guess? Darren, sorry. 1513. Independent countries in the world in 2000. Ben, what'd you put? How about, someone want to give us a guess? 191. Distance between Paris, France, and Sydney, Australia? Austin, what'd you put?
I put between 2,000 and 10,000.
10,540. Number of bones in the human body? No one wants to guess? 206, right. Combatants killed in World War I on both sides? $8.3 billion. Books in the Library of Congress in 2000. No one wants to make a guess. 18 million. If it'll make you feel any better, when I took this the first time, I think I got 3 questions right. And I'm supposed to be the teacher. Length of the Amazon River in miles. We have a number of Brazilian missionaries here. 4,000 miles. Speed of the Earth at the equator in miles per hour. 144. Transistors in the Pentium 4 processor. $9.5 million. Okay, let's. So, people who have not taken this test, how many people got either 9 or 10 right? Raise your hand. Have you taken it before?
No, you said you could use a range, is that correct?
Okay, that's right.
And what was it, did you have to be within 90%? Or I just picked big ranges.
Okay, big ranges. Okay, that's a smart one. How many people got 7 to 8? 7 to 8, 6 to 7. We'll just assume everybody else was below. But we're unbiased predictors. And you can see that half the class we're biased in our predictions. So if that's so do you understand why everybody is above average investors? But the challenge is why and how can we use this to make better decisions? We know the research. The research has showed that people are bad market timers. Yet what do people still try to do? Time the market. We're bad at picking stock because we don't have the skill or the effort or the time. Yet what do we still do? Pick the stocks. We know that from research that all these newsletters out there really add no value. But what do? We still read the newsletters and still purchase. Why? Yeah. Let me just share how behavioral finance can help us to be better. What we need to do is understand our psychological biases. Control your investing environment. Try not to, of course I say it, try not to. I work with the asset management class, and the first thing I did this morning is I go in and I pick up open my portfolio and I see, oh rats, we lost 3 basis points of alpha or something like this. Try to understand, try not to trade too often. Are you overconfident or do you trade too often? Limit the opportunity for these actions. Write down a plan on how you're going to invest. Realize the biggest detriment to performance is us. Number 2, check your stocks once per week when you do your budget, not once per hour. What happens if you check it too often? It causes you to trade a lot more. Make trades once a month, the same day of every month. Does that eliminate the fear and greed? It does. So okay, we're on the 20th of every month or the 3rd Friday or something like that. Review your portfolio annual and rebalance as needed, but rebalance in the most tax-efficient way. Number 2, know why you're investing. Do you know your goals? Make sure you understand your budget. But what's the purpose behind investing? Investing is not an end in itself. It's a means to help you accomplish your goal. Review your goals. Review your investment plan. If you want to trade for fun, that's fine, but realize that's what it is. Put it in a specific account, and when that's gone, it's gone. But be wise in what we do. 3, have quantitative investment criteria and follow it. You've got your investment plan. And so make sure that you use that accordingly. Make sure you follow it. It was written, very few of you have fear and greed in your eyes right now. So you're writing that investment plan when you're very thoughtful and you're logical. things like this. And it was written for a purpose. And I want you to know that if you'll follow it closely, it will save you a lot of heartbreak and a lot of trouble. So develop and write your investment plan. Follow it closely. Don't invest in areas outside of your plan. No matter what your buddy says or your friend says or your church leader says or things like this. Be wise in what you do. And then follow the principles. Follow the principles. Those principles are really important. Invest long-term. Invest tax efficiently. Know yourself. Compare performance versus benchmark. All of these things. And then John Knopfsinger, who actually, I have permission to use these slides, he adds a few more things. And I just thought I'd throw these up here. Number one, avoid stocks for selling for less than $5 per share. Why do you say that? You know, scams are conducted in penny stocks. Chat rooms and message boards, are these good sources of information? Actually, they're very poor sources, so be wise. Before you place a trade on a stock that doesn't meet your criteria, do you think you know more than the market? And unless you've done your homework, you know, be careful. Do you really know more than the market? Number 4, he says, have a goal to earn the market return. He says a lot of the problems that come are because people try very hard to return a higher return than the market. And then the last one is review your psychological biases annually. You know, it's more than just knowing about stocks and bonds and things like that. It's knowing about yourself. It's knowing about yourself and how do you handle. So, behavioral finance, it's a fun area. It causes us to do a lot of things. But if we can understand ourselves, if we can understand our biases, if we do have a well-written plan, if we pick mutual funds or index funds that will be around for 40 years, do we have to worry about the problems and challenges that come? And you know what? Yeah, the markets will go up and the markets will go down. But I think we'll be well prepared for the times that are ahead. Think about what we've taught in this class. So, do we really teach a framework of buying high and selling low, or are we buying low and selling high? You know, think about what we've taught. How do we rebalance? So if you follow the things taught in this class, do you think you can save a good chunk of that $1 million? And I think you can. Okay, let's start with it. Any questions? I have a number of questions that other people have asked. Do we want to just go through those first, and then if there's other questions after that, we can do that? Okay, so let me just hit those really quick. So here are the how do I set up an investment account? Where do I find the distributions? Here's one that came in yesterday. A student wrote, after during the crash of 2000, I saw many portfolios reduced by 70% in value almost overnight. How can we safely and reliably invest when past data may not reliably predict future performance? Why don't we invest in something real, something like real estate or something else real? Yes, real estate can crash too, but it will never go to zero like many other investments. So let's go through each of these questions. How do you set up an investment account? How tough is it? Probably the easiest thing is we could go to a number of different accounts. Why don't we just, well, let me go through this first and then we'll actually do it. You can do it with a mutual fund company, a brokerage bank, and any of the other ones. But remember, when we invest, our goal is to minimize costs, including transaction costs. So generally, what I do is I select which no-load funds I want to purchase first, and then I go directly to the fund family. So Vanguard, Fidelity, Schwab, any of those. And there's a whole bunch of different ones out there. But what I want to do is I want to make sure that that place is quick and compatible. So I know Vanguard, Fidelity, Schwab, those are all quick and compatible.
Are you just asking to read that somewhere, or how do you make it compatible?
Okay, you just ask them. So what I do is I go into Morningstar when I find the fund that I like, then what I'll do is I'll actually give you an 800 number to call. I'll call them and I'll say, hey, are you Quicken compatible? And if they're not, it's not a, then I find something else. I'll find another one there. So what do you need? First thing you do is you set your account type. Is it for retirement or general investing? And then if it's retirement, they'll say, is it Roth or a traditional IRA, a SEP IRA, or a simple? If it's general investing, what kind of securities will you be investing in? And then once you determine your account type, so most of you will probably be a Roth IRA or a general investing account or something like that. Account type, Social Security, birth date, email address, and home address. Number 2, you'll select your investments. Okay, you've already done that as part of your work on your investment plan. So you can actually go in and just kind of select the investments. Make sure you have sufficient funds for the initial investment. And then also check if they charge if you have under a certain dollar amount. A lot of funds will, they may say, okay, you have a $3,000 minimum, but if you'll put in $100 and we can take it from your checking account every month, then we'll waive that minimum. So some funds will do that. Just watch. If you have under a certain dollar of assets, they may charge you a certain amount. Number 3, select your funding method. You can write a check. You can just take the money right out of your bank. So you can put in your routing number, or you can have your bank wire the funds. And then the last one, review and finalize. I thought we'd just go to Vanguard just to give you a sense. And I'm picking Vanguard just because it's an easy one. It's the gorilla of index funds. Not saying, I personally have accounts here, but I'm not saying it's the best or anything like that. There's a lot of good ones. Reese, you had a question?
Yeah, so if you're doing different asset classes like large cap, small cap, whatever, do you have to buy separate mutual funds for each of those and then include all those mutual funds within your Roth IRA, or do you have to have them separate?
Remember your Roth IRA is your shopping cart. And so you could do a Roth IRA with Vanguard. You could do a Roth IRA with any of the other ones. Generally, what I would do is if you want to use with different ones, I might do my Roth this year with Vanguard and pick a Vanguard fund. Next year, you could do it with Schwab and pick a Schwab fund. But just follow the principles that we talked about in this class. So, are you investing or are you Vanguard? So we're just going to come over here to go to personal investor site. Okay, so what we offer, open an account. So the first question here, what's the type of account? So we'll open a new account. Or are we going to roll over a 401k? Are we going to transfer account? So we'll open a new account. Are you registered? Let's just say yes. No. Let's say no. So here's the information. So it's easy and takes about 10 minutes. So what do we need? Your account type, investments, funding method, and review. So we'll continue here. So are we doing retirement, general savings, or college? Retirement, okay. Correct highlight field. Oh, we want to do a Roth or a traditional? Okay. And so now here's where you fill in your information, your Social Security stuff like here. And then what you do, the third part, we'll say, okay, select your funds. So you have to figure out the funds and the dollar amount, and then the last section is just pick your funding method. So it's not a hard thing. It takes about 10 minutes. And so I encourage you to do that. So, and once you've done that, then what you do is you set up Quicken to transfer mutual funds by asset class each week. Make sure they're in their assigned percentages. If it's not an index fund, make sure you can do performance versus benchmarks each quarter. We've given you the tools to be able to do that. Okay, difference between an index fund and an exchange traded fund. I found some other differences that I thought were unique here. So index funds, a mutual fund tracks an index, determined once a day. ETF, it trades daily on the stock market. Now, interesting, can the price and the NAV of an ETF be different? What do you think? Can there be differences between the price and the NAV of an ETF? And the answer is yes. So here's some things. Trades like a stock, ETF. Transaction costs to trade. And the reason I put a star there is some places like Vanguard will allow you to trade certain ETFs for no transaction costs. Generally lower management fee, an ETF. And it's just slightly lower. Potentially more tax efficient. Now, an ETF, you know, as shares are redeemed, doesn't actually have to sell and buy shares. We'll talk about these creation units. So it's slightly more tax efficient, just do a little bit smaller tax turnover. No front or back end loads. If it's a no load fund, you can have the same thing for an index fund. No cost to buy and sell, index fund. Trades once a day. Generally slightly higher fees. And generally tracks the index better. Because ETFs, because the price and the NAVs may be a little bit different, the ETF tracks it just a little bit, or excuse me, the index fund tracks it just a little bit better. Jaron.
I know a lot of index funds have redemption fees, so that if you just buy it and sell it the next day to try and get some arbitrage.
Right.
Anyways, those redemption fees are protected from that. Do ETFs have those, or if you're investing in the long run?
Yeah, ETF. If you're investing long run, does it matter if there's a redemption fee?
Well, no, but I'm just worried about other people taking advantage of the fund.
Yeah. See, I don't mind
I think redemption fees are good.
Yeah.
For investing long
Yeah.
term, but ETFs don't have those, I don't think.
Yeah, I don't think ETFs have those redemption fees, and not all index funds have back end loads.
Yeah, so is that bad for investing then? Long term with an ETF because they don't have those? Or, that's what I'm asking.
Oh, no. Well, let me explain a little bit about ETFs here a little bit better. When would you choose an index fund over an ETF? Small amount each month. Generally, I like the index funds. If it's a large amount and keep it for a long time, I'd probably go the ETF. And are the other differences? So realize financial institutions basically purchase and redeem ETF shares from the ETF. But these are called creation units. And so purchases and redemptions of the creation units are generally in kind. So what it does is it makes ETFs generally have a little bit lower turnover than some of the other funds. And then how is it more tax efficient? ETFs are not redeemed by shareholders. So they generally, it's generally only capital gains. Yes?
How are you defining a small amount and a large amount? You said it was a small amount, probably the index fund, but or are you talking about small?
Well, if I was putting money in every month,
Yes.
I'd go an index fund.
1,000, 10,000, 500, what do you mean by
Yeah,
that?
so large amounts probably in excess of 20 or 30,000. Yeah. But I mean, you guys can have you have the tools here. The good news is you can actually go online, and in many cases, like the Vanguard ETFs, you can buy those without transaction costs. I know Schwab. I was just talking with them yesterday. They have 105 ETFs that you can buy without transaction costs. So if you can do that, you might even buy the ETFs. But be wise in what you do is kind of the only thing here. How do they handle dividends or distributions? That the dividends policy depends on the ETF. And so some distribute dividends monthly, such as fixed income. Others quarterly, biannually, or annually, some equity. Some equity funds, equity ETFs, because they don't hold any securities that issue dividends, they don't issue dividends. They have no dividends. So just be wise there and just understand that. Okay, questions. Where do we find data on fund distributions? Again, there's a number of different websites. Vanguard, Fidelity, American, Schwab, all of them have their own websites, and you can actually go in and see what the dates and the amounts of the distributions. There's a lot of other distributors such as finance.yahoo. Yahoo Finance has a number of distributions. Here it doesn't tell you if they're ordinary stock or capital gains distributions, but at least we'll tell you what the dividends are. And then how do you get the distributions? So let's go on. Let's go to, well, we'll just come here to MSN. Let's go business. Let's see if this one has it. I have it. Oh, well, let's do finance.yahoo. And I'm just going to do, I'll just do the S&P 500. And then let's do, let's see, where's our distribution? To go back to my, okay, oh, it's on the price side. So what we'll do is we'll come over summary, all right, just historical prices. And we want to come over here and we're going to do dividends only. Get prices. So we can actually see what those dividends are. So why would I not want to buy this fund on December 20th? Now the price of this is $143, so it's not going to, a 90-cent dividend is not going to make a big difference. But ideally what I'd like to do is probably buy it on December 22nd. Because if I bought this stock on December 20th, I paid $143 for it. They distributed $1 in dividends. Do I have to recognize that dollar is that dollar taxable? Yeah. So just watch that. This one, I don't worry because the dividend yields are so small.
So wouldn't that also already be expected to be into the price? So you're paying an extra $1 and you're paying taxes on that extra $1 because most of the time they know when the dividends are going to be coming.
Right. So let's just use for example. Let's say at 143 on December 20th, the NAV is 143. On December 21st, they distribute $1. So now the new NAV is 142. But you reinvested that dividend, so you have 1.02 shares. But the downside is you have to pay that. You have to pay the taxes on that dividend. So just watch that. Okay, questions on where you find distributions? Does that make sense? Looks like how about the question is, can you have an actively managed fund in a sleep well portfolio? What do you guys think about that one? Yeah, you can. Number one, you just have to answer the questions. Do you think the fund manager will continue to outperform the benchmark over time? Will he be around in the next 5 to 20 years? Like I said, I left my fund after like 13 years. Do you think it will continue to offer the benefits for which you bought it in the first place? And are you willing to watch the fund performance versus benchmark? So if you're willing to answer those questions, the answer is yes. So, but again, here's my caution here. If it begins to underperform versus over a 24 to 36 month period, and I generally give most funds, 36 months, then you might think about rebalance. You might think about doing an index fund or finding a better one, or at least going with an index fund here. How about where do you find performance numbers for stocks and bonds, mutual funds, stocks and bonds? If we want to compare performance versus benchmarks, and do we want to have to pay for these numbers? Where do we find those? Wall Street Journal's for a good source. I like that they give you data on the Lipper categories. This is from a year or so ago, but you can see all the different categories. Stock and bonds, you can also do S&P, Russell. They actually have this information there. And then stock and bond benchmarks, again, this comes out in the Wall Street Journal once a month. And so just kind of finding it. So here is this question. This is a question that was sent to me on Friday. And he said this: crash of 2007, I saw many portfolios reduced by 70% in value almost overnight. Does this sound pretty dramatic? Do you know any portfolios that fell by 70% overnight? How can we safely and reliably invest when past data may not reliably predict for future performance? Why not invest in something real estate or something else real? Yes, real estate can crash too, but it will never go to zero like many investments. So what do you guys think? How would you respond to that?
You just have to think long term, right? Because even some of the people that had money that lost it, they gained it back the next few years. So it's just thinking long term and just stick to the plan.
Yeah, Chase.
Along those same lines as well, I don't know of very many investments that actually went down to zero and people lost all their money. My dad has a bunch of money in the stock market, and it went down, but he wasn't about to sell it, so he's still holding on to the same stocks, so they went back up. Yeah. He won't sell them for probably 10 more years. So it always fluctuates over time. Yeah. Just gotta hold on to it long term.
Other thoughts? Here's kind of what I responded. Problem one: ones that lost 70% in what asset class? I have no asset class that dropped 70% in 2008. They were likely investing in individual stocks and were not diversified. Did individual stocks drop that? If you were in a risky stock? Yeah. Number two, if investors were close to retirement, they should have had a smaller allocation to stocks as they were older and should have had more invested in bonds. Bonds did better than stocks. So it sounds like they were not investing at a proper risk level. They were taking on a lot more risk than they should have. Three, back our comment here, I know of no diversified portfolio that went to zero. Diversified portfolios are the same as real assets. There will be value there. Think through the principles, not what just you hear or read. Problem four, how do you define real assets? Are real assets only real estate, currencies, precious metals, and agriculture? If this is your definition, you're going to have a very undiversified and risky portfolio because you won't be in savings, you won't be in checking, you won't be in money market accounts, you won't be in a whole bunch of things here. I believe that investments should include real and financial assets as well. And five, how can we safely and predictably invest when past data may not reliably predict future performance? It works for real estate as well. So here's kind of what I thought. Number one, follow the principles of investing. We know what those are. Again, if you do what everyone else does, you'll get what everybody else gets, which is subpar performance. What we have to do is we have to be different. We have to take a road less tragic. Number two, work on the things you can control. How much you save each month? How long do you keep it invested in the market? What's your risk level, your asset allocation? What are the taxes you're going to pay, and what are the costs you will pay? We do this within our investment plan. And really, the one thing we can't control is investment returns. But if we control the things we can, then we don't have to worry. And we can even buy index funds that, regardless of what those investment returns are, we know that's what we'll get. So kind of in summary, investments is not rocket science. It's really figuring out what are the things that make a successful investment portfolio. And we investment in it, it's not a means, it's not an end in itself, it is a means to an end. So our view is if we can figure out what are the principles of successful investing and follow those principles, if we can build an investment plan that will help us not to make mistakes. Remember we talked about ignorance is a covered peril in insurance. It's not in investing. If we can build an investment plan that's clearly written and well understood, that can help us build that sleep well portfolio. Then if we can go through and figure out what asset classes we can do our risk level, and we can pick funds that will be around for 40 years, that are low cost, tax efficient, no small tracking error. All of those things, we talked about those things that make a good mutual fund. If we'll follow those things, and then if we'll pick good mutual funds, and then we invest in those mutual funds, I think the time when it comes to retire or when we need the assets to send our kids on missions or to pay for our kids' educations or to pay for our spouses in our missions or pay for our retirement, we will find that we will have the assets there. Okay, questions? Any other question we didn't talk about that? Thomas?
So I think maybe you covered this in previous stuff, but so when have you used like an investment? Whenever you've gone to an investment advisor? Because from my experience, I think most investment advisors know about as much as I do. They're not. Most of them are not. They're average.
Okay.
And I just wasn't sure, like, when have you gone with them? Like, what kind of stuff?
I don't use investment advisors.
Okay.
And I think most investment advisors aren't interested in you until you have between $500,000 and $1 million portfolio. But realize some people are do it themselves selfers. Do it yourselfers. They like to make the decisions. I don't mind going. I have friends who are fee-only financial planners, and I don't mind with them just talking with for an hour and paying that fee. Some people like help on the decisions, but even if you get help, make sure you understand how that help is compensated. I've got good friends who are financial advisors who are wonderful. And for people who need a hand to kind of hold their hands through the investment process, that's fine. But you still are responsible regardless of who you choose. But if we follow those principles, if they're adding value to our portfolio, I wouldn't hesitate to have them, to pay him and help them. But if we're doing things that I can do on my own, why pay 5.5% for something that I can do on my own? Other questions, please?
Just real quick, how do you get so that if you don't want the dividends to come to you, you just want them reinvested? That's something you can just choose.
That's just an option. You still have to pay taxes on those dividends, but it's an option when you set up the account. They'll say, do you want to send me the dividends or do I reinvest dividends? Right. 1099 div every year. It'll tell you what part's ordinary, what part is capital gains, what part is short term. So each of those things. And if you've got international funds, it'll tell you international taxes as well. Okay. For the taxes, you'll have to pay those taxes when you do your taxes each April. Thanks, everyone.